Trent Bradshaw with Bradshaw Financial Planning. I want to thank you for joining us for the Tax Strategies Update 2018 tax updates. Of course, we'll talk about several strategies and talk about some specifics that occurred with the passing of tax reform. I've got two guests with me today, and again, I'm glad they were able to join me to film this video because we did have inclement weather and we couldn't do the live tax strategies update here in the office, but hope you're taking advantage of it. If any questions pop up while we're going through it, please write those down, give us a call, we'll get you some answers. But I'm glad to have Brandon Rogers, who's a certified financial planner, also a partner of Bradshaw Financial Planning, and also Brent Parks, certified public accountant. He's also been a partner with our firm for quite a while, and I'm glad to have both of them here. They've been great resources for developing this presentation, and I think you'll get some good information out of it. You look at the overall major changes that we've got with tax reform on this slide. We're going to touch on a couple bullet points. What will we discuss today? The first bullet point, as you can see, overall changes to the tax brackets and how long they will last. Also the changes in the standard deduction and exemptions and itemized deductions. And of course, I'm going to ask Brent some questions about that particular slide, and maybe we can talk about some examples and how families may be impacted by that. In addition, adjustments to capital gains taxation, we definitely need to talk about that. That can be strategies that can be applied on an annual basis for clients. In addition, medical expense deductions and 529 plans, there were some changes there. It's something we definitely need to take a look at. Limits on deduction for qualified residence interests, talking about your mortgage interest, whether you got a vacation home, primary residence, so forth. Also corporate tax rates. We'll talk a little bit about that and how that could impact your investments and what we foresee potentially coming up in 2018 and years to come. In addition to that, the last part, we'll talk about a couple strategies that may be applied that we see advantageous not only now and this year, but for the next 8 years until the sundown on the new tax reform that we've got, which will be 12/31/2025. So let's hop right in and let's take a look at the tax brackets. Brandon, we'll kind of defer to you and talk a little bit about 2018, where we would have been compared to where we are now with 2018 and new tax reform laws, and of course what the new tax rates look like compared to the last ones. So can you touch on that and really what the changes were?
Sure. This first slide here is just going to demonstrate, Trent, how the IRS has introduced several new tax brackets. Originally, they were talking about flattening and eliminating tax brackets as part of simplification, but you can see here that we've actually have a couple new tax brackets. We have a 10%, we have a 12%, a 22%, and a 24%. And that's good news to tax filers, because before, our main concern was trying to plan for a lot of folks to stay in the 15% tax bracket. Now you can see that we have a lot of opportunity to try to plan to keep those funds for being taxed at somewhere in that 12, 22, or 24% range. And so you can see here at the 24% tax bracket how at $315,000, that's a pretty significant depth in that tax bracket. So hopefully the goal is to try to be efficient and take advantage of these new lower brackets that are about a 3% discount across the board. And as Trent mentioned, these brackets will be in effect until 2026.
Well, now, Brent, based on that, do you feel like everyone out there can benefit in some way in regards to tax reform and what we will see going forward from that standpoint? What's your opinion on that?
Yeah, I think the general impact is it's a positive impact for most tax filers here, starting here at the tax levels themselves, and seeing that we're receiving about a 3% discount or 3% reduction in tax rates. And so that I think everyone will experience some level of lowering of their tax brackets, especially these individuals that are within this first 24% tax bracket. Everybody should see a little bit of a lessening of their tax burden. Now remember, the IRS is going to come out with new withholding tables, and what they'll probably do is start taking just a little bit less out of your paycheck. And so you'll probably experience a little more take-home pay. And so you may not see this turn out in the final results when you file your tax return next year, because you're probably going to get a little bit of this tax savings, a little bite at a time whenever you get your paycheck. So you may not see anything significant or overwhelming a year from now when you file that next cycle of tax returns.
Well, good. That's some good information. If we look at the bottom of this particular slide that we're on right now, you'll see that the effective date obviously is 1/1/2018. And the way we've set that up, it'll revert back to the 2017 law on 1/1/2026. So, we look at this and it's an 8-year time frame that we can take advantage of these new brackets.
Right.
Within there, I know I'll touch back on some strategies that we'll touch on soon here. And, again, thank you for that information. It definitely looks like, everybody's going to benefit from this in some form or fashion.
For sure.
Okay. If we go to the next slide, basically it's a brief history of the tax rates that we've seen. And what you're seeing here is a bar graph, looking at the overall top limits in regards to the highest tax bracket that we've experienced. Well, right now with the new tax reform, as you can see for 2018, which is the darker line at the far right of the chart, 37% is going to be the top tax bracket at this point. Well, historically, that's still fairly low. So again, we got to take advantage of these new tax brackets and rates that we've got right now on an individual basis. Of course, we'll touch on the corporate side in just a few minutes. But ultimately, historically, 37% is the top tax bracket, still very, very reasonable. On the next slide, we're talking about the standard deductions and exemptions and itemized deductions, and there's a big change here. And I'll let Brent talk a little bit about the standard deduction and then how itemized deductions and miscellaneous deductions may not be there for many investors.
Yeah, everybody's excited about the news of basically the standard deduction almost doubling. And for most intents and purposes, it is almost a doubling, but not quite as much. You can see on this slide the new standard deduction amounts for 2018. You can see the $12,000 for single, $24,000 for married filing jointly, and $18,000 for head of household. So that's a significant increase in the standard deduction. However, you don't hear a lot being discussed, and I think it's on this slide here. It doesn't jump out at you, but look below the box here. Standard deduction doubles and personal exemptions are eliminated. That's significant because in 2017, your personal exemption is $4,050 for every person in your household. And here again, you're going to lose that in 2018. So if you have roughly 3 people in your household, it's almost going to be a one-for-one trade-off between the standard deduction that you're going to gain and the level of personal exemptions you're going to lose.
And again, I'll have Michelle circle that area below the chart, but let's look at the right side of the chart where we're talking about suspension of miscellaneous itemized deductions. Talk a little bit about that and how that may impact the individual.
This section is not used a whole lot. It's the bottom half of the Form Schedule 1040A, the miscellaneous itemized deductions, and you'll see there in the print that those have always had to exceed 2% of your adjusted gross income. And so it wasn't unless you had a significant amount of deduction in this area that the calculation proved to allow you to increase your deductions. But in 2018 forward, the whole bottom section of that Schedule A is going to disappear along with these deductions. And so here again, it may be a situation where not as many people are going to itemize going forward.
Well, some of those areas, and we've got it on the chart here, it includes unreimbursed job expenses, maybe investment expenses like management fees. In the past, you could deduct those. Those are pretty much gone at this point. Tax preparation fees on your end,
right?
Where we were able to deduct those in the past, they're pretty much a foregone opportunity there. Fees to deal with the IRS, again, you can't deduct. Gambling losses, not that it touches a lot of people, but those are not available anymore, and et cetera. It goes on and on. So when we're talking about miscellaneous itemized deduction and exemptions, you definitely need to work with your CPA, certified public accountant, and make sure that if you're impacted by that, so you can understand it. So again, a lot of changes there.
Let me touch on one item, Trent, that you just mentioned that really sparked an interest to me. If you are working in a situation where you're traveling, there's just several occupations that I see where these occupations will claim their unreimbursed job-related expenses on their tax return. and so they are incurring part of the cost of their occupation. The reality is that you're no longer going to receive a tax benefit for that. So to the extent you're able to, it would behoove you to go back to your employer and maybe even renegotiate your employment setup to where if you had to take a few dollars less in salary to generate some type of reimbursement pool, so that you can have these expenses paid in a manner to where they're no longer, you're lowering your W-2 and you're able to ask your employer to reimburse you these expenses directly. And so that's a strategy you definitely might want to consider going forward.
Well, I mean, basically this rolls back down to tax preparation versus tax planning. I know a lot of clients will come in and they'll just drop off their tax information and have their tax return prepped. And that's okay if that's what they want to do. But the real bang for the buck comes from actually sitting down with you and or their personal certified public accountant, CPA, and making sure that they go through this process and identify what they can take and can't take in regards to their tax returns, right?
Right, and the role that I see that this seminar is doing is we're trying to get you this information in January so that you can start making changes throughout this year. What we really don't want to do is come in a year from now and try to educate you on what you can no longer do. We're trying to be proactive and saying, hey, these are some areas that you're no longer going to be able to take deductions for, so you should be planning for it now and not incurring these expenses for 12 months and finding out a year from now that they're no longer going to impact your tax return.
Okay, good. Talk to us a little bit on the next slide here about capital gains taxation. How did it change? Did it change much, or are we still able to apply basically the same rules that we've had in the past?
We really haven't seen a lot of change in this area, which is really encouraging. This 0% capital gains rate, which we've been speaking of for several years now in our presentation. Basically, if you're in the old 15% tax bracket, and you can see that on this screen here where it mentions a 0% tax bracket. If your if your taxable income is within those levels and you have taxable, if you have capital gains or dividends, qualified dividends within that income level, those are going to be taxed at a 0% tax bracket. And here again, these levels are staying intact as far as these are the old 15% tax brackets for ordinary income.
So basically, if we've got an individual investor or a couple that makes under $77,200, we can take advantage of maybe some appreciation in individual stocks and non-qualified accounts, sell those off, and virtually pay nothing in capital gains taxes, correct?
That's correct. Basically, we call it in the industry harvesting some capital gains. Basically, we're stepping up your basis. You could technically sell that stock and buy it back the next day at a gain. You're stepping up your cost basis in that because you can absorb that income in a year that you have the capacity to absorb it and have zero income tax impact. Now just be aware, the state of North Carolina doesn't go along with this strategy, so there's going to be about a 5% cost of doing it as far as your state income tax.
But ultimately, if you have that advantage, paying 5% on a gain is a lot better than paying it at ordinary income tax rate, right?
Just like you were saying, we're trying to implement planning so that 3 years from now, if you need money and you have to do a major cash out, we're trying to control the flow of income on your tax return instead of being reactive and doing it in a year that you may need some extra capital.
Okay, great. So hopefully you got some ideas in regards to capital gains in that area. What about medical expenses? And then again, I'll transition to some point here with Brandon to talk a little bit about the 529 plans. But talk to us a little bit about medical expenses, because I know a lot of individuals run into that and how they were able to apply it to their taxes and get a deduction for it in the past. Where does that stand now?
Well, it's encouraging news, Trent, that in 2017 and 18, they're going to hold the threshold to 7.5% of adjusted gross income as far as the deductibility for medical expenses. And
so where was it in 17? Was it at 10%?
It was at 10% if you're under age 65, and it's been at 7.5% if you're over 65. So the good news is that everybody is going to be under that same calculation for the next 2 years. And so we don't see that many individuals that are claiming medical, but unfortunately we see some where you have somebody that's experiencing a long-term care type environment, and if those folks are spending a lot of money, that 2.5% could make a big difference on the amount of their deduction for 2017 and 18. And so just kind of keep that in mind, and you're just not going to know whether it's going to benefit you or not before you go through some calculations.
Okay, good. Let's switch over, change gears a little bit, and talk about 529 plans. We've got some exciting news there. I think a lot of families out there will find this very interesting, and it's kind of exciting to me personally, knowing that we potentially have some funds we can use now prior to college. Brandon, talk a little bit about that.
Yeah, so within the 529 place, there's a lot of changes happen there. What you usually in the past had to use the 529s for were for higher education, so basically your college type expenses. But now they've opened the door to use that for K through 12, so basic kindergarten through 12th grade expenses, as well as higher education too. So there's a lot more flexibility there to say if you had a child that had to go to a private school or some type of not a public school for kindergarten through 12th grade, you can certainly use a 529 plan now for those expenses. So there is a limit there of $10,000 per year per student, but again, that's something that really opens the door to 529 plans and really something to look at. They were playing around with the idea of homeschool expenses, but they did not include that, so it can't be used for homeschooling expenses. But again, it can be used for kindergarten through 12th grade and higher education. So that's pretty massive.
So this really opens the door for families that maybe didn't have the money to afford private school for their children in the past, but now if they have 529 funds, they can actually use it for that K through 12 in private school if they choose to do so, up to that $10,000 limit.
Mm-hmm. Yeah, they can use it up to that $10,000 limit per person per year. And 529 plans, grandparents can open them up, aunts, uncles, mothers, fathers, or whatever it may be. You can have multiple 529 plans for the same person if you wanted to.
But again, homeschool is excluded as far as expenses, as far as that's concerned.
Yeah,
Okay.
Homeschool was counted out. Yeah.
But ultimately, that's great news, fantastic news now that we got a little bit more flexibility with the 529 plan. So again, if you got any questions with that, let us know. We'll do some research for you. See if you qualify to take advantage of that or not. Okay. Next slide we've got is talking about qualified residence interest. This is a biggie. I'm going to transition back to Brent to talk a little bit about the mortgage deduction and the changes that were applied, because if you own a second home, this one might catch you. So Brent, take this one.
Yeah, this is nothing new as far as the limit on the amount of home mortgage interest you can deduct. You can see in the second paragraph that it used to be $1 million. If you owned a home and your debt on that was $1 million or greater, then your interest was limited and you had to prorate the deduction of the interest. Unfortunately, the IRS has lowered that threshold to $500,000 it's actually $750,000 is the limit. So it's basically taking it down a little bit. Generally in our area here, it's probably not a big problem, and maybe a lot of our viewers aren't, but just be aware that if you do have a mortgage interest, a mortgage balance of $750,000 or greater, your interest deduction is going to receive some type of limitation. Now, the first paragraph is even something that most people may not realize, but the interest on a home equity line is no longer going to be deductible in 2018. And that's going to affect a lot of individuals. I see that quite a few deductions in that area on tax returns that I prepare. And also be aware that I don't think the slide mentions this, and Trent may have mentioned it, but the interest deduction on vacation homes are no longer going to be deductible only.
What's the solution there if you do have a vacation home, you're unable to deduct that? I mean, do you have an opportunity maybe to do some planning around that to benefit? Maybe yes, no?
Yes. Everybody, the strategy involved would be considering whether you want to convert your vacation home into a piece of rental property. The IRS is going to continue to allow the interest deduction for rental property. Rental property is considered income producing property. And so if you have income producing property, you can deduct the expenses related to that property, including the carry of the mortgage interest. And so you would have to consider the benefits of whether you want to convert it into rental property, have other people using your property, but in fact it would allow for that interest deduction if you decided to make that decision.
Okay, so the biggie in regards to the qualified residence interest is really the home equity line of credit. If you got a home equity line of credit and you're paying interest on that, as you can see with the first part of this slide, the interest paid on that home equity indebtedness is no longer deductible. So again, that's a big change. So be aware of that, again, as part of the planning process that you need to do with the CPA. Let's transition a little bit, talk about a strategy in regards to charitable giving. This slide is titled Qualified Charitable Distributions. Again, this strategy has been around. Matter of fact, I think President Obama made this permanent back in 2015, but prior to that, we had to battle this strategy year after year after year, as basically they had to renew it on a yearly basis, but now it's been made permanent. Brent, talk a little bit about that in regards to the qualified charitable distributions.
I think this strategy, Trent's going to become a lot more popular, and the reason being is because you're going to have fewer and fewer people that are going to be able to itemize their deductions, and that being because their standard deduction is going to be greater than the sum total of their itemized deductions. That being the case, there's still going to be a lot of individuals that are interested in making charitable donations. And so if you're over 70 and a half and you're not itemizing your deductions, there's no reason for you to write any more charitable deductions out of your personal checking account. You should go to your IRA and the trustee of that account and have those distributions made directly to your charities, and that will keep that income off of your tax return. And so you won't have to worry about picking it up as income, because the deduction for the charitable contribution is not going to impact your tax return because you're already using the government standard deduction.
Okay. So again, you've got to be 70 and a half. It's not necessarily just your RMD, but it's up to $100,000 that you can send directly from a qualified account. Instead of it showing up for income, you can send it directly to the 501 or the 501c3.
Yeah, any type
charitable organization.
That's correct, Trent. And so here again, you would probably be able to advise them as far as the trustees and how much flexibility they have and how often they can make these distributions. But the big picture is you really don't want to be making any more of these contributions out of your personal checking account if in fact you have an IRA and you're required to take money out of it.
Okay, well that's good advice. But let's look at it from a flow chart standpoint if we're talking about required minimum distributions, because you're right. I'm starting to see investors take a look at this and start picking up additional distributions from the qualified accounts and sending it to the charities directly. But this is kind of a chart. You want to touch on that real quick?
Sure. This is just kind of an image, as it would try to just show exactly what we're speaking of. If you follow the top of the chart in the red boxes and you take that income personally, it has two impacts on your tax return. It obviously increases your income and could potentially increase your income tax, but at the same time, it's going to go into your base of income to compute how much of your Social Security is taxable. So it's almost a double whammy by taking that income onto your tax return. And here again, unless you're just a heavy itemizer, that you're going to exceed the $24,000 standard deduction for married filing jointly, the bottom path is a much easier and straightforward path in the green boxes. Here again, you contact your trustee of your IRA account or your financial professional, and you talk about wanting to set up these donations. It may be that they can set up as reoccurring. Here again, the logistics of it, can be discussed, but the merit of it is we take this donation directly out of our QCD, and it doesn't hit our tax return. We don't get a 1099 for it. We don't also get a charitable statement from the charity because, it doesn't hurt if the charity sends you an itemized statement that it includes. You just want to make sure that you don't claim that on your tax return, because this in fact is being contributed through your IRA funds.
Well, and the biggest part about this strategy, though, is having income from an RMD when you don't need it, required minimum distribution from an IRA or a 401k, whatever it happened to be, qualified account, it could impact your Social Security. So it could make your Social Security taxable. So this is a strategy that we can apply. And again, it's been made permanent now going forward. So it's definitely an asset that you need to take a look at. All right, let's talk a little bit about tax rates, corporate tax rates, and how that could impact you as an investor as far as your investment accounts are concerned. And we'll transition this one over to Brandon so he can take the lead on it and talk about what we're seeing at this point.
Yeah, the corporate tax rate obviously we just covered all the individual sides and how we're going to be impacted by it, and that's going to be some good changes on there. But really, the positive I think that has really been driving this market was the intentions of hopefully getting this bill passed last year, and then also going into obviously the first quarter of this year. The market's really responding very well to it, and here's the reason why. There's a lot of these corporations out there were paying taxes of you see there 35%. Well, now it's been reduced from 35 to 21% as far as what they're having to pay. So really, what you're seeing is a lot more cash being made available to these companies. So a couple of different ways to kind of interpret that and how companies you've already seen respond to that. Some are hiring more labor forces, they're increasing salaries and bonuses for their employees, or they're going to be moving funds from other outside of the U.S. into the U.S. And that's really what that picture right there showing next on the right. It's just moving funds from outside the U.S., bring them back in the U.S. A prime example of this happened just the other day, where Apple CEO Tim Cook said they're going to move about $250 billion from outside of the U.S. into the U.S. and pay taxes on that. And then what are they going to do with those funds? They're going to turn around, open up a new campus, hire more employees as well, and really just pump more money into this economy. So that's a huge benefit. They're estimating it should be around a $350 billion impact to the economy. So that's really why you're seeing the market take off and seeing these companies. And again, that's just one company out there making possibly a $350 billion impact. So that's pretty massive.
Well, and it's interesting that you said that, because I heard an interview the other day with Warren Buffett. I think he was on CNBC. Mm-hmm. But he was talking about how the corporate tax rate going from 35% to 21% will help companies increase their overall earnings per share, simply from the simple fact, if you use the example, if you're making $100 million in profits, instead of netting $65 million after your corporate tax rate, now you're only paying $21 million in taxes, so you'll net $79 million. Mm-hmm. So the difference between $65 million and $79 million is fairly significant. Yep. It's pretty much a 20% to 20 plus percent increase on earnings per share, just simply from the corporate tax rate being cut from 35% to 21%. That's driving a lot of enthusiasm on Wall Street right now. So if you're invested in the market, we both have the same opinion that this is a driving force behind what we're seeing as far as positive attitude and individual investors coming back to the market in mass because of this. It's a positive for Wall Street in general. Mm-hmm. Okay?
Sure. Definitely.
But what does the future hold? What can we do? What are some strategies? What are we looking at? What are some concerns that we could apply when it comes to the investment side of the equation, and how that can impact you from the tax side? Brandon, take a look at or explain what this slide's about. I know we're going to talk a little bit about David Walker and who he is and what his opinion is, but it kind of leads us down the road of what we could try to benefit from in the investment accounts.
Yeah, thanks, Trent. The David Walker, so a lot of you may or may not know who he is, remember who he is. He was actually the comp controller for about 10 years under the Bush and Clinton era. And really what he was the CPA for the U.S. government. So even back when he was, and this is a quote from him from the 2008 time frame, is, regardless of what politicians are telling you and what you're seeing out there, when he's pouring over all the numbers and he's looking at the debt that we're in, and obviously it's gone up tremendously since 2008 when he said this statement, there's no other way to handle our ever-amounting debt burdens except by doubling taxes over time. So it's a very interesting concept to think about, is where our taxes rates, as we saw earlier, historically, it's pretty low. You look all the way back from the beginning in 1913 till today, you can see obviously the ups and downs of where taxes are. And today it's not really that bad. And then we just got really those brackets redone and adjusted, and they're pretty low. And again, as we said again, and we keep saying, it's important to know this, is that we only got until 2025 so far for these tax breaks to be there. So if we go to the next slide here, this is on the left side, the 2018 tax rates, just where they are currently, the 7 different brackets from 10% all the way up to 37%. What you got to think about, again, as we saw that slide earlier, is where are we historically? And if you look on the right side, obviously not too long ago in this 1960 to 63, that's where the tax rates were. Lowest was 26%, scaling all the way up to the highest at 87%. So, I mean, it's been done before. Are we going to revisit this? No one really knows, but history tends to repeat itself sometimes. But in the middle bracket right there, you're looking at what could the future hold. So if you can kind of see, draw a line across from the 10 and 12% brackets, could be around the 25% to the 63 in the mid range, or the highest at 88. So a lot of uncertainty there. And at the end of the day, we all know we're going to have to pay taxes, right? Everybody's going to have to pay it. You're not going to be able to avoid them for the most part. So how should we do this? Do we want to pay taxes at 12% or so, or 22% wherever you're at? And if you do, that's okay, because even if tax rates go up by just 1%, you've made the right move. So just different strategies to look at depending on your situation, and we can certainly discuss going forward, but something we definitely want to take advantage of again over the next 8 years.
So with the differences in the tax rates, taking more income out of qualified accounts, moving it to non-qualified, and/or maybe doing some Roth conversions,
right,
and going ahead and paying taxes in that 10, 12, 22, or 24% tax rate,
yep,
may not be a bad deal.
Yeah, and
because historically we potentially could be up to that 25 bracket going forward based on history.
Right, exactly. Yeah, and that's all really got to ask yourself is where are we at today? And with the ever-mounting debt that we have at over $20 trillion, what's going to have to happen? And do we think tax rates are going to go up in the future? If the answer is yes, then there might be definitely some opportunity there.
Okay.
Which actually is a good segue to the next example that we have out here. And it just kind of really puts it pen to the paper and lets you see some of the figures there. So as you see on this slide, we're looking at possibly Roth conversions. Again, that's something Trent and I, we all think is a great opportunity if it makes sense for your situation to really maximize this, again, through that 2025 time frame. So we've got an example here with the married filing jointly couple. At the top end of that 12% bracket is income of $77,400. Well, again, as Brent mentioned before too, the standard deduction doubling. So if we take that $24,000, add it to the $77,400, we actually get a total amount of $101,400, and that's still taking still taking income at a 12% bracket. So that's pretty unbelievable and a pretty low rate if you think about it. So that's something that we need to look at and to see. And basically what we're saying is if you're taking $70,000 a year and you still got room, another $31,000 or so to fill up your 12% bracket. So let's fill up that bracket. Now we either do it through Roth conversions, or we can do it for just taking money out of the accounts, paying tax on it, and using it now, or putting it back. So again, different ways you can look at that. And then we just took it a step further. What if you did it at the 22% bracket? Sounds pretty reasonable, as we saw, as history tells us. Is married filing jointly couple, you add in the standard deduction as well. Now you're up to $189,000. So again, 12% to the 22% bracket is a massive jump. Don't get us wrong, but it still could possibly make sense. And again, also think about this too, as this whole tax system is a progressive system. So again, that's why we are saying fill up your buckets. Fill up your 10% bucket first, fill up your 12, then go to your 22 and 24, and so on and so forth. So your effective tax rate could possibly be lower. So that's something definitely to keep in mind, and it will be a massive strategy to look at for the next couple of years. It's a great opportunity.
Brandon, you used the term buckets, and I don't know if you were looking at the image there, but I don't think it's by accident that we've got buckets here on our screen. And the whole concept is you really just don't want all of your income in one bucket. If all of your income is in your qualified account, perhaps you're in that red bucket. And here again, you're going to need money to live off of as in the future, and you just want to have some flexibility in case we run into several years where those brackets spike up. You want to be able to access funds from several different buckets, all of those colored buckets there. Hopefully you have some of buckets filled that's money that you've already paid tax on. And here again, that's what Trent and Brandon are emphasizing, is that you think it's bad to pay tax at 22%. It may not be. There's a lot of room at $189,000 to take those funds out, and we would hate to get 10 years down the road when these brackets change and find out they're a lot higher, and we missed some opportunities over these next several years.
So, taking money at 12% and paying taxes on it and putting in your non-qualified brokerage account or checking account or whatever is not a bad strategy. But then we can look at Roth conversions, probably most advantageous. But on the other side of things, from a tax advantage standpoint, life insurance cash values can be accessed based on current legislation, tax advantaged. So there's really three buckets outside of qualified plans that we need to concentrate on and try to put some money into, because going forward, tax rates spike. Again, we're going to be able to take the advantage of taking money out tax-free. And we're trying to drive those uncertainties out of the equation when it comes to your financial future. So a lot of good information today. I really appreciate both of you joining me today and talking about the potential tax opportunities and strategies that we can apply. Again, if you've got any questions in regards to what we talked about today, or maybe we didn't touch on a certain subject that you wanted to hear on, that's fine. Take the question down, give us a ring, shoot us an email, whatever. We'll do the best we can as far as getting you an answer. Again, I appreciate you taking the time to join Bradshaw Financial Planning today, and also Brent Parks, CPA. Hope you have a wonderful day, wonderful week. We'll be back with additional education and webinars. And again, if it generates any questions, let us know. Hey, join us on social media. Stay in touch with us. We'll send out information constantly in regards to market updates and reallocations and so forth in regards to the investment accounts. But again, thank you for your time today. I hope you have a wonderful week, and we look forward to seeing you soon.